Welcome to the Dividend Talk podcast, episode 150. What are we doing with 3M? A dive into their settlements. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. How are you, my friend?
Really, really good. I mean, the summer is starting. The weather is nice, and you know what they say always, right? Go away in May, but remember to come back in September. Of course, I'm not selling my entire portfolio here. The nice, beautiful thing about dividend investing is that you don't care about this. It will continue to do well usually during the summers because we buy stable businesses. On the other end, we're talking about the stock today, which is also an evidence that not every stock in our portfolio is maybe the safest, whether it's summer or not, but just in general. But yeah, no, I'm doing well. Really looking forward for the summer. How about you?
Yeah, we have a little bit of a mini heat wave over in Ireland, which is rare. We always get it around this time exams kind of start, which is good. Our friend Russ has landed in Ireland this week, so he gets to enjoy the beautiful countryside with this glorious weather. So it's a nice time of year. I'm looking forward to some more sunshine, and yeah, it's nice. It's nice. It's really relaxing.
So are you telling me that we will see some more red people in Ireland?
Definitely, yes, yes. This is like the fifth or sixth day of continuous weather above 20 degrees. Usually means we're going to have a water shortage in about 2 or 3 days. We don't cope too well when it's warm, but
Oh,
there'll
wow.
be a lot of people with we call farmers tans. So
Yeah.
you'll have like they wear t-shirts, so they'll be red or brown from the say the sleeve down on their t-shirts, and then their body will be completely white and they'll have a red face. So yeah, that'll be a common sight.
Nice, nice. So hey, I let's get started with the news of the week, Derek, because there's one thing that I really want to talk with you about. And we got actually a question around it already a little bit last week, but I really would love to hear your opinion. So the news of the week here is like that Target started removing some of their LGBTQ products after threats. So people were throwing those things that were being on display on the floor and everything. There were some volatile circumstances in some of their shops. So effectively, they started to pull their merchandise out again. And for instance, there were in there like gender fluid mugs, children's books titled "Bye Bye Binary," Pride 123, and "I'm Not a Girl." So there's this good old saying, "Go woke, go broke." But I'm just wondering, like, how do you look at Target? And why I'm asking, the share price is now around $130. It hasn't been trading there for a long time. 10 billion of market cap got wiped out after this news. So what do you think when you hear this?
Yeah, I mean, I think we touched on it last week that when they've released this kind of collection, they're trying to jump on a trend. We know that this LGBTQ is really, really in the news the last maybe couple of years. And companies are just trying to get on that and maybe try and target new customers. But in doing so, I feel like they are alienating some other customers. And it's a hard balance for me, but I really think that they're really trying to throw this stuff in our face a little bit too much. I have no problem with the movement, and I'd have no problem with Target putting in a collection. But come on, children's books titled "Bye Bye Binary." I just can't.
Yeah.
I can't deal with that. I mean, kids, you're forcing stuff on kids who are not even mature enough to make their own decisions yet, and you're forcing this kind of crap on them. Just There shouldn't be
Yeah.
any kids' books on this. When you become an adult and you're aware of your body, you're aware of who you want to be or what you want to be binary, be fluid, be whatever you want. I've no issue. But when it comes to kids, I mean, I'm not a fan of
Yeah.
that. But in terms of the company itself, would I look differently on them? No, it was a marketing campaign that went wrong. And how many companies worldwide have had marketing campaigns that go wrong?
Yeah.
Probably all of
So
them at some point.
I also saw a bit of a podcast from the CEO, and I also analyzed Target not too long ago. I think I did a video about it. And, in its defense to Target, Target has always been a front runner when it comes to diversity and inclusion. So their whole history is about that. It is in their DNA. Um, when I see that as well, right, I do believe that, yeah, it's then kind of normal that a company like Target is practicing with this, and because they really believe in it. I believe I see also, for instance, when it comes to gender diversity, they have, I think, half of their store managers is female, which is really good, I think. But I think also personally they overreached here a little bit. But it is, on the other hand, a bit in their DNA. So although I thought initially it was a marketing campaign maybe go wrong, but on second thought, remembering what I analyzed about the company, this is Target, yeah, as
Yeah.
such. So, but now if you start then putting your business hat on, they acted swiftly, yeah, by pulling it out, specifically in the more, let's say, conservative states, I guess, to not piss off too many people. So they responded to it. So it's not just pure ignorance only. And for me, these kinds of things, I don't believe they will lose long term many customers with this. Because often when you think about supermarkets, it's about proximity, walking distance or not. Okay, I guess in the States more about car, whether you can park your car well. So for me, I actually see it more as a short-term buying opportunity. And while my valuation is lower than 130, I did look at the yield and the growth history and the payout ratio. So I bought 10 additional shares this week to just take use of the opportunity and nibble a little bit in further, because it is a great company in my opinion. But I hope they really see it as an experiment and not that they start pushing the boundary even further and that it doesn't motivate them even more.
Yeah. Or if they want to introduce this in terms of diversity, they can, but maybe keep it away from the kids section. Keep it purely adults. And I think maybe that's where the biggest outrage is. Well, what I'm seeing
Yeah.
online is when you're targeting kids with these things. I think let kids make up their own minds. Put up a collection, put up T-shirts, put up banners, put up whatever you want, but stick it in the adult section only.
Yeah, exactly. Okay, then the next news, and I need to give you, I need to give kudos here to Coffeezilla. Do you know Coffeezilla, the YouTuber?
No, no.
Okay, so Coffeezilla is like a guy who's just doing his own investigation about scammers, and he has some really popular videos already. Like also how he dialed into this. What was it? This guy from FTX, from this coin exchange platform.
Yeah.
He just released a video about uncovering a 500 million scam. And what is really interesting here is that there were quite some wealthy people and celebrities, and they have there an example where a guy deposited $1 million to a company called Traders Domain, and they, even when they were transferring money, they had to put services in the description because it was not about trading and such, because then they would get in legal troubles. But you know what the biggest issue was that people were attracted by? They had a claim that in 3 years they can make 437,000% in gains via day trading. So then you have got these people here that are, these kind of get quick rich schemes, right? And they earned quite some money, maybe some popular YouTubers and such, that thought like, oh, I can make some quick buck here. And the typical happened. After a certain moment, they were not able to pull their money out when it went a bit south and such. But I mean, this was a great reminder. Like, even people that are successful, yeah, and you would think they understand a little bit about money, are being subject to scams which are advertising 437,000% in gains. Now, for me, this is flabbergasting. This news, like, how is this possible? And then actually, I know also you mentioned often about your past about I said being subject to impulse and such when it comes to investing. But for me, this is really flabbergasting. Like, if I would have 1 million, even if I would have 5 million on my bank account, whatever, I wouldn't do that. I know myself. I wouldn't do that.
You have to question the sanity of these celebrities and wealthy blokes. I know you can get caught up in scams, but someone offering 4,000% gain, it doesn't even sound realistic. And you're putting in a lot of money. I mean, if there's $1 million deposit into this, that's a lot of money that you're expecting back. I I don't see how, if you were sitting there logically thinking about it, could you expect to get anywhere near that amount of money?
Yeah. If you put 1 million in there, they're probably expecting 4 billion out of it or more.
It's pure greed that is all they got caught for there. Nothing more, just
Yeah.
greed. They wanted to become a billionaire quickly, and unfortunately, anyone offering 4,000% is more than likely going to be a scam.
Yeah. So I will put the link to the video in the description. It will be a 3-part series. He released the first one, but oh boy, I mean, he's really worth watching. He has uncovered really some scammers and really good ones.
Does he give names? No, probably not.
Yeah.
He
Yeah.
does.
He is at risk at the moment, right? He's getting threatened and everything. So
Any celebrities we know?
no, he's not. I mean, in the first episode, not yet. I mean, he had a few people that were on camera explaining what happened to them. But of course, he's investigating the company behind it, the guy behind it. But he exposes everyone. Yeah, he's no bullshit guy.
Your kind of guy, like it.
Yeah.
Okay. We have only a couple of dividend hikes this week. We have American Tower. They hiked their dividend by a measly 0.6% to $1.57 quarterly. This is kind of one where the dividend growth is starting to slow down over time. It was really popular for a while, this American Tower, and we're starting to see dividend growth slow down. So I'm interested to hear your take on it. Were you looking at this company before?
Yeah, I've been at least doing a bit of a screening, and it was always too richly valued for me on a price to FFO. But currently, they, at least from a price point of view, they've come down. I think they're a multi-year low, around a multi-year low. So maybe I will look at it again. The question is why it's slowing down. Because if this is kind of structural slowing down, then you should also use lower multiples again than before. Yeah. So that's the question: is the catalyst gone or not? And that's something I will look into.
Good. And then the last dividend hike I have is Lowe's company, ticker symbol LOW. They hiked their dividend by 5%, which is not too bad.
I think so. And it's always the question between Home Depot and Lowe's. And in Europe, we have Hornbach as an example, Castorama as well. I think these companies will continue to do well. There's a lot of still home improvement going on everywhere. So yeah, a nice one, and congrats to all the Lowe's, shareholders.
Yeah. So today we are going to talk about 3M. Why did we choose today to talk about 3M? I suppose they've been in the news quite a bit lately, both positively and negatively.
Yeah, let's say that first of all, I think it's a dividend darling, or a former dividend darling, with 65 years of dividend growth. But the stock price dropped over the last year from almost $200 to $100 now. Yeah, and it was, I think, $92 or $94 earlier this week. Then Friday, it got a really steep bump to 102. And the reason for that is also some news around the settlements. And there's also a reason why we are talking about it, right? Because the litigation issues that they have, they're really severe. We never really spoke deeply about what it means to the company and what it really is about. So I would really love to have this show a little bit of a fact-based discussion about it, because most what we see in social media and such are simply the headlines. But for me, it's always really important to remember, why do you own a stock? And do you know actually what you own? So I hope we can address this topic a little bit today, and then also answer, like, what will we do with our shares? At least what will I do also with my shares?
Yeah. Yeah, makes sense. And for those that I'm pretty sure that most people will know about 3M, but just as a quick intro, you did mention they are a dividend darling. In fact, they have 65 years of dividend growth, which is why you can see they're quite popular in the dividend growth community. I'd imagine if we were talking about this company in 2018, 2019, our thoughts would be a lot different than what they are today,
Yeah.
which is quite something. They operate in four main segments: so safety and industrial, transportation and electronics, healthcare, and consumer. And I've named them in order of revenue as well. So safety and industrial is around 12 billion worth of their sales, and consumer is the lowest at around 5 billion. But I'm pretty sure most people will at least have heard of 3M or have used some of their products. So I don't think we need to go deep into what they do. But there is two main elephants in the room, isn't there? It's these litigations, and there's two of them. There's two of them in lockstep. I think a lot of people might be forgetting that there is two different litigation battles going on.
Yeah, and talking about forgetting, the Everything Money guys on YouTube, they did just a video about 3M, and where this guy, this Paul, is saying like, "Oh, I just initiated position and bought some." He did a whole valuation and didn't mention any of the litigation issues at all, at all. So sometimes I wonder if they are really doing their homework, because they are always saying like, "We are here to teach you how to fish," and he even mentioned it, right? And then they do a video and don't a 10-minute video and not mention it once. So again, I'm also on YouTube. I also write a blog, but guys, please do more homework than just looking at the numbers. If anyone would have Googled 3M on the first page, you would have already seen something about the litigation. I mean, please embed this in your research. Don't go blindly on us or on what you see on YouTube, because people might forget about it, or in this case, people might even not have researched it, and then you really don't know what you own. But okay, let's yeah, and this is the group that calls out others for being clowns, right? That's
Yeah,
the fun
yeah,
part about it.
yeah. And they're also trying to push their own product constantly, so that's why they
Yes,
focus on the numbers. Yeah,
exactly. Having said that, there are two main litigation issues here. One is PFAS, and the other one is around the earplugs that is being used in the military. And maybe why PFAS is actually so bad, right? So generally speaking, right, researchers have found that PFAS, which is actually an industrial product used since the 1950s, for instance, in computer chips and non-stick frying pans, cosmetics, that never breaks down naturally. And the issue is it gets into the landfills and therefore also into the waterways. And it's even just not possible to properly clean it that easily. So effectively, our water is being intoxicated. Now, the U.S. Environmental Protection Agency, they say that PFAS is linked to development delays in children and increased cancer risks. And some researchers have linked them also to specific cancers. Of course, 3M disputes this, and I said, and they continue to mention that PFAS doesn't pose any significant threat to public health and welfare. But yeah, that's nice. But we know by now with Monsanto and Bayer and Johnson Johnson that that's not how the American court system works. So it comes down a lot to settlements. So, you can imagine this is a big issue, and it's not just an issue in America. It's also an issue close to home in Belgium, in the Netherlands, there in the water in the river there. So, I mean, they're really, really, really in trouble. Now, so what happened then, right, in the news this week? There was some news around 3M striking a tentative settlement of at least, it's really important to say at least, 10 billion over the water pollution claims tied to those chemicals, what they actually call forever chemicals, to insiders with this deal. And that's where the share price really jumped on. And, this is really interesting for me that the share price jumped so much on this. I think it jumped even as much as 11%, because this is 10 billion. Yeah, but I read an article somewhere, because yeah, no, before I go there, what's important, this settlement is only for a small area
Yeah,
somewhere in South Carolina.
yeah, that's what I was going to
Yeah,
get to. Yeah,
and this is the consolidation of 4,000 PFAS linked lawsuits. The total guesstimate of the entire settlement globally is as great as 143 billion at a current market cap, let's say, of around 55 billion. That's what we're really talking here. So I don't get this. I really, really don't get this hooray and cheering in the stock market.
I was surprised when I seen the stock price go up so much, and I had to go on Twitter straight away, and I see settlement, settlement, settlement. As you said, what struck me first was that this is a tentative settlement of at least 10 billion. So it's not concrete, it's not set in stone, and they're going to pay at least 10 billion. And then for it to be for 4,000 lawsuits in a small part of America, you're talking about South Carolina, which relative to the wider American population is quite small. So I didn't understand this whole jubilance about the stock price going up
Yeah.
and everything seemed to be okay. I mean, this PFAS, I'm not even going to try and pronounce the long name for that, but
Mhm.
basically it's a synthetic chemical. It's known as a forever chemical, as you said, because it's never going away. And if it affects people in South Carolina, it's going to affect people all over America. And if they win this in South Carolina, what's to say they won't win that, say, in Texas or Idaho or anywhere else that they have this going on? And that's before they even get to Europe, which is different when it comes to lawsuits as well. It's that big figure of 143 billion, which is quite scary. Now think about it. The free cash flow last year was around 3 or 4 billion.
Yes, and their long-term debt is 13 billion,
Yeah,
13.
yeah. So I mean, where's your where's your dividend cover there? I mean, how they can't. You're talking about bankruptcy here. That's what you're talking about. You're talking about a company going out of business. That's a hell of a lot of money. I don't think it will. Look, that's worst case scenario. I don't think it's going to be 143 billion. But even if you take a fraction of that, 40, 50, 60, 70 billion, it can do a lot of damage to this company, particularly for dividend growth investors who I believe are probably the main types of investors in this type of company.
Yeah.
Because it's slow
Yeah.
growing. There's not a lot of growth. There's not a lot of transition or change. There's not a lot of catalysts. It's just steady growing, and it pays a steady dividend. That's the whole lure to this company. And without that,
Yeah.
what do they have?
Yeah, and I don't understand also a little bit at the moment the credit rating agencies. Of course, they mention about it, but why with this litigation overhang it is not considered junk, yeah, or at least close to junk? Why does it still have an A rating? That's what I don't understand, because it is as much also a future look into the company.
Well, to give them some credit, sometimes we don't like to give them credit all the time because we know that their interests are linked. If they did that, the stock price would collapse. Let's be honest. And at the moment, we're talking ifs and buts around numbers. We don't know the hard fact numbers at the moment. This is at least 10 billion, potentially up to 143, but we don't know that. So for a credit rating to go out and say this is now junk, it would have a huge effect on the company. So
Yeah.
I think they're in a bit of a rock and a hard place. They probably would like to downgrade them, but if they do, it would have a disastrous effect. So, but it also shows you that you can't just rely on credit ratings. It's good to read them, but in times like this, you really, really, really have to know what you want and do your own research.
Yes, and if this sounds already depressing, we haven't even spoken about the earplug litigation. So here again, right? It's about at least knowing a little bit what it is about. And the interesting fact about earplug litigation for me was, and I had to do some additional research again for myself, is that this was, these 3M earplugs, and maybe this is the irony, it was actually a result of a collaboration between the US military and their representatives and Arrow, the company that they acquired. Yeah, so this earplug was kind of co-created with the military in the late 90s. And with that, they created a second version of what they call the combat arms earplug. And this one was designed to really eliminate the need for soldiers to carry two different sets of earplugs. Yeah, so it was like 2-in-1. So they could then warn it in one way to block the sound like traditional earplugs. And if they would warn it the other way, it would block only certain types of loud battlefield noise while still allowing to hear other kinds of sounds. So I guess to be more responsive in the battlefield. Luckily, I've never been in a battlefield, but that's what I take away from it. So the issue now really with those earplugs is that they can be too short in a particular wearer's ear canal and can fail therefore to form a proper seal to effectively protect the inner ear from the damaging noise. Yeah, so that sounds to be quite a design flaw that we are talking here about. And now I also understand like why they are having these issues with earplugs. Although you might argue, like why were people wearing them anyway? And because here I would also like to think a little bit like, guys, there's also something on the military side, probably where they could have been doing a bit better job, specifically if this pops up after 20 years. But talking about buying a cat in a bag again, right? So for me, 3M bought this company and get all the litigation shit in their eyes. So in this case, also just news like 2 weeks ago that a federal judge has ordered the CEO to attend a mediation meeting aimed at resolving nearly 260,000 lawsuits. Yeah. You know, what is probably good to know, 3M has lost already 10 of the 16 cases that were brought to court. And this costed them about 265 million of fines, let's say. And yeah, you want to say it? Go ahead.
I mean, look, as you said, 265 million for 16 cases on top of the 450 million in defense costs. This is 16 cases. They've got 260,000 lawsuits here. That's a lot of I can't even calculate that off the top of my head. That's billions. That's billions and billions. I mean, this is potentially going, like, we've got two serious lawsuits here, and either one on their own could potentially put this company out of business. It's quite scary when you look at that, and it's worrying for me when I see all this on Facebook, Twitter, YouTube. 3M under 100. It's like AT&T under 30 that time. It's that same type of feel. I think people are getting lost in the history of the company. Yes, they have a 6% yield. Yes, they have a good history. But also, come on, look at their potential costs here. They're potentially going to go bankrupt here.
Yeah. And this is where I think we also need to, I said, really give credit to people that really look into that. And wasn't it Russ also who did a movie about 3M that really said, like, guys, watch out with this one.
Yeah.
And yeah, for me, this is insane. But just already the defense costs. So when I read defense costs, I think about lawyers. Yeah. 450 million. That's, even if these lawsuits of both PFAS and I said, the other one, the earplugs, turn out well, they will still like add like a few billion probably in debt just because of lawyers.
I mean, if you want to invest in someone in this scenario, find out who's representing 3M. Invest in that business.
Yeah. And if they are trading, if they are on the stock exchange,
even if they're private, try get your money into that company somehow, because they are the only winners here. Really, they're the only winners. But of course, look, 3M, they got smart guys in the boardroom. They're not stupid. They know this is happening. They know this is potentially blockbusting. It can wipe them out. So they're not sitting around idle on their hands. They are trying to prepare a little bit about this. And on their last quarterly results, they did announce some restructuring actions. And if I take the line directly from their report, it says 3M is taking restructuring actions that are intended to make 3M stronger, leaner, and more focused. I really wish you said laser focused there, but essentially they're trying to free up as much money as possible to fund these litigations. Some of that is by making roughly around 8,500 positions redundant. That's it's a lot of people that they're letting go, and that's going to save them. They say pre-tax of up to 700 to 900 million. You're probably looking at after tax 500 million in savings there.
$500 million additional cash flow. Yeah, I mean, it feels for me like they are trying to find this penny jar. Yeah, when you get home, you throw your pennies in there, and then after a few years, you can buy something from it. I feel that they are reaching this stage soon because they need to find money everywhere. And yeah, I think reducing, closing down stuff. I think that's one way of doing it. The other way is like innovate yourself the hell out of this, by a new business. But for me, the issue is now like this company is really, how you say it, it's in a sandwich. Yeah, what can it really do now? It just needs to have successes in these lawsuits. That's
Yeah.
what it needs.
And that's exactly what it needs. And then I look at the company and think, okay, have they got any tailwinds? As you said, they need to do something and innovate the hell out of it, come up with new products, buy new businesses maybe. But I don't see any tailwinds. What do I see? I see, okay, they're exiting the Russian market after the invasion of Ukraine. That's hampered them a little bit. We can see the revenue has dropped, not significantly, but a nice portion. The respirator demand went down after COVID. Pricing limitations, all this stuff before the pandemic that we can see inflation hitting them really hard for some of the products that are really price sensitive. And I think a lot of people are playing too much hope on China reopening and the demand increasing. But I see too many headwinds and not enough growth or tailwinds for me. And I just don't see the catalyst. I don't see the story for buying 3M right now.
Yeah. Well, we sound really bearish and depressed about this stock, but shall we at least close it with a valuation? What our stock dashboard says.
Yeah, let's give the numbers.
Okay. So, is the dividend safe? Our dashboard says, based on the metrics, it's questionable with a score of 41, and 41 is just above unsafe because we have the boundary of 20 to 40 as unsafe, so just above it. The reason for that is that they have a 5-year average free cash flow growth in the minus. They have a slow 5-year average EPS growth. The debt equity is 85 towards the 100. And the payout ratios for free cash flow stand at 83% and the EPS payout ratio of 70%. And you usually get points if it's like below 60. At the same time, we believe that the growth prospects of the company are weak. So yeah, this is the reason why the dividend is questionable. Now, maybe some statistics. If you look, for instance, at the earnings per share back in 2015 and the free cash flow per share at the time, then the free cash flow per share is now lower than what it was, let's say, in 2014, 2015. So we are like 8-9 years down the road, and we are not making the same. We're not generating the same cash. Earnings per share looks good generally, more on the high end. Now, over the years, they have been reducing their share count from about 700 million shares to about 560 million shares now a decade later. But that comes also at the cost of debt, because their long-term debt went from, from about 12 billion in 2017 to in 2020 to 18 billion. But they have been paying it off afterwards because of the COVID cash flow that came in, and not repurchasing so many shares at that time. So they are back at 13 billion now, and they have been particularly, I think, buying back. Or I say paying down debt since they know about these litigation issues. However, if you look at debt to equity, it's standing now at 86%. And if they indeed will settle for 10 billion, and they need to fund it via debt, and not share issue, because dilution is really at risk here. yeah, then the debt to equity number will shoot through the roof straight away. Just this small settlement already for a really sub portion of their entire lawsuit. Now, if we look at the entire key statistics, right? 5-year dividend growth of 5%, but the last 2 years it has been growing with, what is it, less than 1% probably.
Yeah.
So we shouldn't take too much joy out of that number. And if we look at the return on capital, it's currently around 7%, slightly above the weighted average cost of capital. So the numbers just have really deteriorated over the last 3-4 years, although they had a bit of a free cash flow boost from COVID. Now, if you take this all into consideration, right, and you use 4 billion in free cash flow, that's where it is about right now as a baseline, assuming that they are able to maintain their sales net from the litigation issues. If you then consider, let's say, a growth rate for the next 5 years of 4% and then 2% thereafter, which I think represents a little bit our feeling about how the business is doing.
Yeah.
At the discount rate of 12.5%, because we are now in another interest rate environment, and maybe for the risk, you should actually put a discount rate here of 20%. But okay, let's stick with 12.5% and then a terminal multiple of 14. You know, based on let's say what you would like to pay for this business would then be $88. Yeah, so $88 means that it's still overvalued. Based on our forecast, how we look at the business. If we start to include here also 140 billion in litigation, the intrinsic value of the company would turn into 88 billion in the minus, and we're effectively talking about bankruptcy here. Yeah, if it would be even half, yeah, then still we are talking about a negative intrinsic value. So, you know, this doesn't look bright. Just the numbers just don't add up. The company is still overvalued based on our growth forecasts. And yeah, so tell me, do you have a position in 3M?
No. Luckily, I don't. I got out after the announcement of the latest litigation, and I'm kind of happy that I did. I mean, you mentioned their dividend safety score was 41. I think we're being a little bit even optimistic there because we're giving it a little bit of credit in terms of its dividend history. We're saying it has a 5% 5-year dividend growth rate, which it has, but I don't think we're going to see that going forward. And it also has 65 years history, which gives it a bit of a score. And couple that then with the A1 credit rating. So I think those three are inherently not
keeping
correct.
It up.
Yeah. So I would actually put the dividend into unsafe territory, and the risk of a dividend cut is really, really severe, in my opinion. I mean, look, we've been really negative on this, and I don't know if there's many out there that has been as negative as we have been, but I just can't see a catalyst for this, and the numbers, as you said, do not add up. So I don't have a position. I was kind of to and fro beforehand that if they got good news on the earplugs, that maybe it might be a good time to maybe buy into them. But I'm actually reconsidering that based on everything that we've talked about today. I don't even know if I have any interest in looking at this company anymore. But I know you have shares.
Yes. I have 50 shares in this company because I've been accumulating them over the years when it was going relatively well, right, on the dip. So my average share base is around $150. So yeah, I'm 1/3 in the minus. So I have like $2,000 in the minus. At the moment, it's having a yield of 5.8% or something like that. So, you know, based on this, I cannot do anything else than sell. So what I will do is I will start probably selling like 10 shares here, 10 shares there, and straight away reallocate my funds into another stock. I don't want to keep 3M. I hope I will be able to sell it during the summer. Yeah, maybe now I will sell my first 10 stocks this week. Because if I do all at once, then I don't know where I should put all the money in at once. So, and I also don't think like in the next 2-3 months, suddenly the share price will be at $20 or bankruptcy. Yeah. That's not how quickly this develops. So I will take my time during the summer to unwind my position. And from there, I will practice not FOMO, but actually JOMO, the joy of missing out, because there are so many other stocks in the world. I mean, we're just talking about Target.
Yeah.
Yeah, of course, different yield profile, but also 50 years of dividend growth. Has some headwinds now because of some news, which I don't think is a fundamental impact to the business. So there are just much better stocks out there. And yeah, I'm going to get rid of my 3M. And I'm really happy that we did this show, because until now I was a little bit like reading the headlines as well myself, but also I'm so busy at work that I have hardly time to analyze stocks. So taking 3M now and doing a bit of a deeper dive to really understand the problem has really helped me making this decision. And I've learned to listen to our dashboard. Every time when it rung unsafe, the dividend got cut somehow in the next 12 months.
Yeah.
And I can see three options here. The company will dilute the hell out of shareholders. They will take massive debt on, or they will have to file bankruptcy, maybe not as a company as a whole, but parts of the business, because probably it's a spider web of legal entities.
Yeah.
So I don't see how they can pay a growing dividend. And if they do it, it will be the Houdini act of the century from a dividend stock point of view.
Yeah. But that risk far outweighs any positives for me. So it is something I'm definitely not willing to bet on. The only thing I would say from your perspective is they've had some good news. Once we don't have any more negative news over the summer, we know the debt ceiling agreement has been reached. So it looks like more money is going to be printing. That usually finds its way into the stock market. You could see this by default go up a little bit closer to your average baseline, which mightn't hurt you as much.
Yeah, but could also go lower.
It could. If there's any bad news, it's for sure it's going lower.
Yeah, no, I've learned to not think like that. In the beginning, as an investor, I was always trying to make up my losses. I've learned to not do that. Just cut it. But for instance, I can use this reinvest the funds maybe at stocks that are trading around 5 to 6% yield as a high yielder, with a better dividend safety here. And that's how I at least protect my dividend income to some extent.
Yeah, and of course you've held these for a long time, so your net loss won't be as large because of the dividend income you would have earned from them.
Yeah.
Okay, we have a ton of listeners' questions, so I hope everyone enjoyed our bearish view on 3M. I would love to hear everyone else's opinion. Do you agree with us? Do you not? Let us know. Facebook, Twitter, anywhere. But we have a load of questions to get through now, so we'll do our best to get through as many as possible. And we'll start with Richard's one. And Richard asked the question, are you close to the boring middle part? How do you have any ideas to combat this and stay on track?
And he means the boring middle part, like the middle of the year. That's what he means, or middle of the journey of dividend investing.
See, I wasn't sure, and when I read it, I thought it was the middle part of the journey. That's what I assumed.
Well, I would advise Richard to start a podcast then.
Yeah,
it really does something to it.
He can start by coming on to our podcast. I would love to have Richard on. He's such a clever and fun guy. I would love to have Richard on the show. As I said, I'm going to stick with the theory of the boring middle part of the journey. And how I stick with it is, I know you released a tweet about your May income. I haven't yet, but man, this was my best month yet. That's how I stay motivated. My record last year was June last year, which was €629. May this year, I'm on €645, and I expect June to be even better. So it's actually, I couldn't believe it. I didn't open my broker once throughout May, not once, and I just calculated it all yesterday, and I got some shock. I was not expecting it to be so large.
Yeah, and this magic is just doing wonders. I mean, what can you buy for it, right? You can probably pay the whole month of fuel, as an example, your electricity bill, your phone bill.
Yeah, I mean, in Ireland, that's an average weekly wage. So whatever you could buy for a week after tax, that's what I could buy with that. So it's quite a big amount. Now, obviously, May and June, we have a lot of European companies. It's inflated in those months, but it's definitely motivating to see that you can earn that type of income in a single month. That's what keeps me on track.
Yeah, and Try imagine how you were trying to save this amount of money just 10 years ago.
Yeah,
Yeah.
of course. Yeah, 10 years ago, even when 18, 19, that might have took me maybe a whole year to save that amount of money. So,
Yeah, that's the power of dividend investing. And for me, it never gets boring. But I understand what he means. Like in the beginning, you fall in love. Yeah, you have really this like in your belly, these butterflies and everything when you discover dividend investing.
yeah.
You can't stop reading and everything. And this is like a marathon. Yeah, so you're now at the stage, maybe at the 20-kilometer line, where you start wondering, like, shit, I still need to go halfway. My legs start to hurt a little bit. So and that's why I think Richard, the community is plays an essential part of it on Facebook and on Twitter, because here we help each other out and keep each other motivated and do the refills with water, do the cheering when you're passing by, right? That's what the community is about.
Yeah, and in our dividend group, the saying that goes, anytime anyone talks about something ridiculous, like if I'm talking about trading penny stocks, for example, you'll get straight away, stick to dividends, boys and girls, straight away. So it's yeah, the community is definitely one way to stay motivated and on track. Centrino, it's not a question from Centrino, but he has an awesome suggestion, which I agree with. He says, European DGI, you should create a video course on how to analyze the three financial reports. He would buy it, and I'm pretty sure most of the community would buy it also.
Well, that's really flattering to say so, but I don't consider myself a guru in this or something like that. There are way better people than me that can explain this. I did, let's say, a half-year accounting course. So yes, I learned how to read it and everything, but I'm not a specialist. Sometimes I see answers on social media about balance sheets that I need to go back to my 1,000-page Bible of accounting standards, and I wouldn't have guessed this or found this. And Centrino, I don't want to be in a position um, where I'm effectively causing issues with people that are investing based on things that I maybe understand wrong. So I'm a bit on the conservative side there. I use really my videos to explain how I'm doing things, how I'm looking at things, but I really feel like everyone should be accountable for their own money-making decisions. And I said I do know that some people copy things that I'm doing, and I already feel uncomfortable with it. But if I would ask even people money for a training, I feel like that's when the moment where you go from inspiring and being an amateur to becoming a professional. And then you may also expect from me being a CPA or something like that, and I'm not. So I don't expect I will ever do this as a course. Never. I also am not on social media to earn money with this. I do like when people buy me a coffee because it covers my costs for licenses, for video editing, for keeping my blog online, because there are quite some costs involved. But other than that, no way. No. Thank you, Centrino. Very flattering, but I don't think it will ever happen.
I will say, if you do change your mind, I think it would be a great idea, but I will disown you if you put on Twitter, quick, only 5 copies remaining.
Then please unfollow me. Yeah.
Tiago asked us when we expect to get the Dividend Talk yacht. When we become the new Warren and Charlie, when they're talking about EDGI and Derek as the new Warren Buffett and Charlie Munger, that's when I'll buy a yacht.
But it wouldn't be a yacht. It would be such a small boat where we need to paddle ourselves, because we know where we want to earn. We will buy a yacht company rather.
Exactly. Hey, that's not a bad idea. Dazzy Mikey, luxury stocks like LVMH, Hermes, Prada, Kering, or luxury brands are taking a bit of a beating lately on the news that demand for entry-level designer goods is dropping in the US of A. What's your view on luxury stocks and Kering in particular? So for me, we talk about these. We talk about Louis Vuitton all the time. Hermes, we've talked about. We've even talked about Kering. And I always struggle with these types of stocks because they've always been, one, overvalued, but two, they've always outperformed the market and seem to do well in challenging times and times I would not expect them to do well. And I was thinking about this last night when I read the question. And some of the reason I believe that they do so well is I don't think their target audience is the middle class like us. I don't think it's aimed at people that will struggle in recessions. It's aimed at people with lots of money that want to have all the nice clothes, that can afford to have the nice clothes. And generally speaking, recessions don't really affect them a whole lot. So I can understand why they do quite well. But I would struggle personally to buy these companies because I feel in my mind that they should be struggling during a recession. But in terms of Kering, I think I think it's a fantastic company. It has really strong brands. And if you look at the annualized dividend growth rate, their 10-year annualized dividend growth rate is 14%. The 1-year annualized growth rate is 16%. And now you're getting a 2.8% dividend yield starting as well. So it looks quite attractive from that point of view. They have cut the dividend in the past as well. They have strong revenue, strong cash flows. But for me, it's just valuation for me with these companies. It's always quite high.
Yeah.
You're always looking at a 30 PE ratio for these.
Yeah. Of course, I wish I would have some of those, but I don't know. I got a bit of a thick skin of not being too afraid of missing out. We get this question a lot, but I mean, I think it's in the Netherlands where we have expression like better one bird in the hand than 10 up in the air. You know, I have Microsoft. It gave me this kind of multiple expansion plus growth story. So, you know, I've got my part of it in my portfolio. It's good enough. And once they come down, trade at proper valuations, and there's still enough catalysts, I will be a buyer, but not at all costs.
Exactly. But I can understand the fascination around the brands, the brand power that they have. We speak about brand power quite a lot, and these companies certainly have them. So in terms of your question around Kering, I think the yield is decent. They're trading at around 17 trading PE ratio. So it looks like it's actually not too bad compared to, say, Louis Vuitton. But like that, I do expect demand. Personally, I would expect demand to weaken over the next year. Certainly with the prices and inflation going the way it's going. So not for me. Martine has asked us, have you ever heard or ever checked out Lotus Bakeries, ticker symbol LOTB? What I have to say is I didn't hear about them before, but I believe I looked at a lot of companies yesterday, but I believe they were a Belgian company. They make cookies and all sorts of bakeries. But the first thing that struck my mind was, look at that share price. 6,000 euro nearly for this company. I couldn't believe it. And their dividend is 45 euro per share. Obviously that gives it a low dividend yield, which would not meet our criteria. But honestly, it looked like they did quite well for a bakery company. I don't understand how they're making so much money, to be honest with you. My only concern is that the free cash flow is a little bit choppy. It is now negative last year. The trailing 12 months is also negative. It's been declining, which for me poses a risk to the dividend. But the dividend has been growing. It looks quite strong in terms of the growth. But the free cash flow would worry me, particularly a bakery as such. Now, I don't understand the whole business. It's a brief overview, but that type of company and that 4 PE ratio is a whopping 39 euros. So far too expensive. And I would be worried about free cash flow. But yeah, it was impressive to see that 6,000 euro, a 45 euro dividend. So nice.
So then Dividend Yogi is asking our opinion on the weak performance of pharma stocks at the moment, and do we consider to add some more? He asks about Johnson & Johnson, AbbVie, and Roche, for instance. So yeah, I've been buying Johnson & Johnson just to add a little bit to my position. I do this usually on the dip, and that's what I've done here. And AbbVie, I've got already a full position, so not so interesting for me at the moment. How about you? Have you been buying any pharma stocks?
I haven't been, but I'm looking at adding to Johnson & Johnson, particularly in the dip. AbbVie, not particularly, and Roche. I really like Roche as a company, but it's the Swiss dividend tax that I hate. So you have to look at them after tax. But yeah, I think pharma stocks, as you said, they are weakening at the moment, but that presents good opportunities to buy pharma stocks. So it's definitely a sector to keep an eye on. Alex has asked us, do you have any internal principles on how frequently or for what amount you should purchase European stocks to maintain a European flavor dividend growth? investing with?
So I don't have any principles, but I do measure, let's say, on a half-a-year basis, how my portfolio composition looks like from a currency point of view, and then I make adjustments. So generally speaking, naturally about the opportunities that come my way, by also studying European stocks, I actually do quite well. So I usually don't need to adjust.
Yeah, me too. I don't really have any principles. I am around 50-50 by default. The only thing I would say is that if I was coming into buying, particularly around May and June, you look at usually European companies, the ex-dividend date is a few days before they pay. I'm more likely to maybe take advantage of European companies at that stage. But as a whole, I don't have any set criteria, but I am roughly 50-50 at the moment.
Yeah, I've got 55% in US dollars and the other 45% in euro, British pounds, Swedish crowns, these kinds of things.
Nice. DG investing. How do we buy US Treasury bills? As European investors, we can't buy on Treasury direct, and he doesn't see value to buy on the secondary market.
I don't buy. I'm not interested in them.
Yeah, I haven't a clue, to be honest. I would agree with you. I wouldn't be buying something like that on a secondary market, but I have no clue as a European how I would even go about buying them. So, sorry. Davide has asked us, what are your thoughts about Unilever right now?
Not a lot. I want to see more of. I want to see more stronger performance from the company. It's of course an iconic company struggling for years. LOTB out. I want to see them a little bit more returning to growth. Now, if I look at the ice cream prices and I look at the magnums, I do expect some proper margin growth over the summer, because I can really see that they are probably taking a benefit out of inflation. So there's where I have some expectations that they will show a bit of growth because of what they've been doing with the packaging and the pricing. I feel that they are increasing the prices way above inflation. Also, Axe deodorant that I used for some time seems to be like 40-50% up compared to last year, at least here in Poland. So these are all Unilever products. And yeah, I have now high expectations about the profit itself, but generally saying I think Unilever needs to find out its way, its path back to growth. And it has been going through this phase several times in history. That's why the dividend growth is not there. They're really conservative about it. But I think 20-30 years from now, they will do well. The question is, then it's now a time to buy. I think there are better moments.
Yeah, I agree. I've kind of put Unilever to the back of my mind. They have a position. I mean, look, they have a new CEO. You have to give him a chance as well to see what the company is doing. They're kind of yo-yoing between 42 and 47 in terms of price range. So yeah, I'm not expecting a whole lot of growth, and I'm just leaving them sit there. Just one that I'm happy to forget about at the moment. Toko Buno has asked us, what are our thoughts on Palfinger and Infineon? So Palfinger AG, they're an Austrian company, and it's quite strange that we hear a company from Austria, but they are involved in the selling of cranes and all that kind of equipment, which I think is quite an interesting business model. You know, like the telescopic booms, the scissor lifts, and all those. So I found that quite interesting in terms of a business model. They have a 10-year total return of around 2.86%, which is not great. The dividend yield is 2.65, and their market cap is around 1 billion. Looking at the company, I actually thought they were okay. I did have some concerns, as I said, in the industry itself. It's quite a small business. The free cash flow is extremely choppy. And I suppose the first thing I look at when I'm looking at a company that I don't really know anything about is probably their free cash flow. How much free cash flow are they able to bring in? Can they afford that dividend? How much debt have they got? Their long-term debt is around 450 million compared to total revenues of 2.3 billion. So their long-term debt is around 66%, which is okay. It's middle of the road. But I do have concerns about the dividend in terms of if their free cash flow is safe. But I think it's an interesting business model. Cranes, we use them all the time. The second company, Infineon, was actually a little bit more interesting for me. It actually reminded me of the days when I was back in college talking about MOSFET transistors and discrete and non-discrete chips. So they sell all these kinds of things. I forgot about most of that in my college days because I've gone on to a different role, but it was definitely interesting. It's a German company, first of all. We missed this when we covered our German companies. They have a better 10-year total return. It's 20%, but their dividend yield is only 0.89%. But in terms of free cash flow, it is definitely a lot better. They generate roughly 1.5 billion in free cash flow. Their dividend is only 500 million. So you can see that's quite good. Less than 30% payout ratio. They've got very little debt. They do. They've got 5 billion in debt. So their debt to equity is 32%. And their dividend growth was also quite good. So of the two companies, I would definitely look at Infineon, but their yield is definitely too low for me. But good dividend growth rate. 10 years is 10.3%.
Yeah, Infineon, I think, reminds me also about composing my own desktop PC, where you could buy the RAM from Infineon as well.
Yes, and that, I'm sure that's what they have as well. They sell all that, but they do all, I don't know, diodes, transceivers. Let me see if I can remember my days. IGBT modules and transistors and amplifiers, all this fun stuff, which is quite important in today's electronics, I have to say. I'm sure they have some LED technology and lighting, if I remember from my days as electrician as well. So definitely
nice
of the two, the most interesting company.
Yeah. Okay, then Emma, yes, two questions, and the first one is like, what do you think about Alexandria Real Estate?
So, not a whole lot. I've heard about these a few times. Dividend Seeker talks about them quite a bit on Seeking Alpha, also on Twitter. I don't really have too much of an opinion about them, but I think it might be good to have someone like Dividend Seeker on the show. I know he's quite popular on Seeking Alpha, talking about REITs, to get his opinion on these types of companies. I don't know. Do you have Alexandria?
No,
or do you know them?
No.
I'd like to have someone with a bit more knowledge on real estate investment trust to talk about these types of companies.
Yeah, exactly. Maybe we can get Brett Thomas also one time. Having said that, he also asked like what he wants to add some consumer staples to his portfolio, and he's considering Target, Kroger, Diageo, or Coca-Cola. And which one do you like the most at this point in time? For me, it's Target at the moment. But also Ahold Delhaize is coming a little bit again down, which is also a company that I maybe want to round up my number of positions into the 100. I've got more than 100, but like a nice round number, and not anymore like 68 in the end, let's say.
Yeah. For me, Diageo and Coca-Cola would be the two, but Target, as you discussed earlier, could be a buy as well. I really like what Coca-Cola did in terms of the restructuring, and I don't think we've seen quite the benefit of that yet. We have some tricky times since they completed that, but I think they've put themselves in a really good position. And look, it's Warren Buffett favorite as well, so Coca-Cola.
Exactly. Hey, then Tim Ainley from Facebook is asking Kone or Otis, and I think we're talking here about the business of escalators and elevators, I guess.
Yes, both of them the same. One is an American company, one is Finnish, I believe. As Europeans, we have to stick with Kone.
Of course.
They've been around a lot longer, and they've also paid bonus dividends in the past. They have a longer dividend history. Both quite similar business models. But hey, if you're unsure, why not buy both?
Yeah, exactly. Then Alex, our moderator, also in the Facebook group, is asking like, what do you think the future holds for office REITs? And this is a really interesting question, because it's actually a question about the new normal. Yeah, and do we still need so much office space? compared to what we needed before. So look, I think it comes down to which office REITs. There will be some office REITs that are probably high on debt, being in poor locations because they couldn't compete because of, for instance, the lack of quality management, the lack of network, the lack of proper business deals. So I would really go to those office REITs that are, I mean, for instance, Wall Street. Yeah, I think there's still a good reason to have your office on Wall Street there. Yeah, that's something different than when you're in the outskirts of Watford, as an example.
Yeah.
Yeah,
Yeah.
with your office space. So I think it just requires more homework and more due diligence. But honestly, it would have required that already before COVID as well. But maybe at that moment in time, if you just threw a dart on the board, you would have done well.
Yeah.
And that's, I think, there are fundamental changes. Companies don't need so much office space anymore as before. So I do see overall office capacity shrinking in the world, specifically for the knowledge working industry. Yeah, you need to make sure that you have companies that can weather that and don't have too much exposure to it.
Location, location, location. I think that's key. And finding quality real estate investment trusts that could potentially rebound. The only caveat I have is I don't know which ones are quality or not in terms of the space. But yeah, this made me think a lot last night. I honestly don't think the office culture is dead. Personally, I know it will reduce, but people working from home on their own, it can be quite lonely and isolated. And I think long term, this might have some impact on people's personalities and mental stability and stuff. So I think having an office space is good to interact with people, other humans, adults. So yeah, I think it's a very good question. But
Well, if you say like mental health is an issue for people working from home, you can also do it like this: you buy an office REIT and you buy a pharma stock that is strong in antidepressiva and such. Yeah, and you have the uptake on the other side.
yeah, I'm just talking about my own experience from working at home. I struggled with it. I didn't like it. I only did it for a short period. I think it was 2 or 3 months. And luckily I was needed. I'm more of a hands-on engineer, so it's hard to fix a machine from my room
Yeah.
here. But I couldn't imagine doing that forever because I
No,
knew
but in the IT industry, it has fundamentally changed, Derek. I work there. We need maybe 25% of capacity to the past. People started moving out of the cities, working on distance, and the office space is still needed for people to meet, but it will be a bit more meaningful. And I don't see that coming back in the next decade. There's no need for it either. We are used to, I mean, there makes no sense for many office workers to just sit all the day in a cubicle talking to people globally. Makes utterly no sense, and that will not come back, not anytime soon.
Yeah. Cool. Adam Bacon has asked us, do you take notice of upcoming ex-dividend dates when deciding between a few stocks to invest in?
No, not at all. No, just not at all. Not at all.
I touched on it above. May and June, yes, I will look more at my European companies. I think it's a good, if you're buying them for the dividend, it's probably a good time to buy them just before ex-dividend date because they pay typically once a year. So if you buy them before, you get the dividend. If you buy them afterwards, you'll have to wait nearly a whole year again. So that's the only time. But then if it's a European company like Unilever that pay quarterly, for example, it doesn't bother me because there's always opportunities and you're not missing out, right?
Yeah.
That's the only time I would look at it. Paolo Piera has asked us our thoughts on 3 different stocks. Anglo American, which has a ticker symbol of AAL, not American Airlines. It's a different one. Carl Zeiss Medtech, which has a ticker symbol of AFX. And then the last one is BASF, which is ticker symbol BAS.
So, BASF, I think, I mean, I'm a long-term shareholder in this one, and I know they have issues, and they were a lot in the news around, let's say, how you said, the gas imports from Russia and such, and all the sanctions. But this company is well managed, good balance sheet, safe dividend. And I think the scare in the media is a little bit over. The stock is still priced low from compared to where it has been historically trading, but also shows the cyclicality of the business. But I think, and again, this is how I usually think, right? I think 10, 20 years from now, BASF will be doing better than what it's doing today, unless it gets some litigation because it might have some old industry. God knows what they have been all producing in the past. But generally, I'm good with BASF, and the other two companies I simply don't know. I understand indeed that AL is a mining company, but not a stable dividend. So I would definitely already shy away from it. And Carl Zeiss is a medical device company for eye disease. That at least appeals me because I see catalysts there with an aging population, eye diseases. So I just don't know it, but a low yield and a high PE makes me already not interested to dive into it.
Yeah, similar kind of thoughts. I really think kudos have to go to BASF management. I think they've navigated this past 12 months extremely well. And I don't see an issue with their dividends. You're getting quite a high yield there. I think it's around 8%. So I have to say, I'm really happy with my position in BASF. AFX, as you said, medical device company in the eye disease. I mean, like that, it would interest me. But I read their products, I read their pipeline, I read what they're involved in, and honestly, I have no clue if they're good or not. It's just a lot of big fancy names to me, and they could be good, they might not be good. But I had a look at their yield, which is 1%, and their PE ratio, which was 36, and I decided not to look any further. And AAL, as I said, mining company. I'm already in and out of Rio Tinto. I don't need another one. Again, you're getting quite a high dividend yield here, but it's variable as you would expect in that industry. But I think for me, sticking with Rio Tinto is probably makes more sense.
Yeah. Then Marek has a really interesting question, and he's saying that recently Sven Carlin has told that his investment strategy is not to beat the market, and it's not a game he wants to play. And what do we think about the statement? And it's actually a really simple question, Marek. I dream of being financially independent because it will give me opportunities that I don't have today. Effectively, it means like I can then decide if I want to continue working or not, whether I want to do charity or not, whether I want to do travel or not. I haven't made up my mind there yet, but that's my dream. And my only focus is in realizing that dream. And to realize that goal, to reach that dream, I've put a financial plan in place. I know what I need to invest. I know at what yield and what the dividend growth should be. I'm kind of halfway on track for this. And that's my only measure of performance. I was just talking about 3M and selling it at a loss. I think if you start thinking about beating the market, you get all kinds of incentives to not do that and maybe to wait because you might then fall into the value trap thinking around 3M. So I'm also not playing that game. But if you look at it generally, I think the S&P 500, was it last year when it dropped 20% or the year before? And my portfolio was almost flat. So you win some, you lose some, but I usually don't even properly track it.
Yeah, I always chuckle when people talk about beating the market, or if you underperform the market. It's almost like a yardstick of who's better than who at investing. But honestly, I don't really care too much about it.
Yeah, but it's also, I mean, it makes sense when you think about it. Should you otherwise just not put it in an ETF? Why do all the work? Yeah, just buy an S&P 500 ETF or whatever you want to benchmark it against. But that works only when you take a capital appreciation strategy and, for instance, using the 4% rule for financial independence. We are on another strategy. We're on a dividend income strategy. So why then the only thing you need to make sure is that you realize your plan.
Yeah. The income in my pocket doesn't care if it's beating the market or not.
Exactly. It only cares whether it will grow or not.
Yeah. Lars has asked us, why don't you pick 5 to 10 Chowder Rule stocks and stick with it?
I'm not clever enough for that, because it would give me a bit of anxiety. What if I'm wrong? I can imagine, like, if I'm financially independent, I keep that portfolio as my engine, and then just start really picking 4 or 5 stocks and building that really out over time. But I don't have the guts to try and do that. The money that I put into it, that comes out of my work, is too valuable for me to try that. For me, it gives me a feeling of increased risk, even if theory says that it's probably lowering the risk. It gives me, like German says, an unheimlich Gefühl.
It's quite refreshing actually to hear someone say they don't have the guts to do that. You'll never hear someone say that about themselves in terms of investing. But I think it's quite honest and quite refreshing. It is. You have to really trust yourself as an investor to pick 5, even 10 stocks and know that they're going to do reasonably well. I think that's the reason why most of us have 40, 50 stocks in our portfolio. We don't trust ourselves quite as much as we think we do. Derek has asked us about inflation. Inflation and the cost of living crisis is affecting many retail stocks. Is it wise to be overweight in one sector like retail and then wait for it to rebound in a year or two? Also, what do you think about Target, which we spoke about, and Dollar General as long-term plays?
So, this is the issue with dividend investing, right? That we look at macro trends because it's what's in the news, and inflation is real. Short term, it might impact companies. I think the impact of inflation has not hit the consumer yet as hard as what reality is telling us. I think COVID gave us a lot of opportunity to increase our savings account. And I think, and I actually know of one person in my private situation that cannot cover their expenses currently with their income because of inflation. They are now eating up their savings, which they actually got from sitting at home during COVID. So I think it comes with a delay, this inflation. I think it will really, it's the most predicted recession, right? But I still think it has to really hit people. And where it hit, I think lots of studies have been done about it, but the companies that I doubt the least about are the Target and the Aholds and the Walmarts of this world, because usually where you save money is dining out, not buying this new car, but just giving it a maintenance repair. That's the behavior that I see and that I also do myself. So I think just using this Peter Lynch thinking, I think will allow us to spot which companies are more sensitive to this kind of consumer spending behavior.
Yeah, I think looking a year or two out is too short of a time frame for the retail sector in this scenario. As you said, it hasn't really quite played out as much as I thought it would in the retail sector. And we need to find out what the new normal is. We had a period of low interest rates with basically no inflation, and now we went the other way. So it's going to balance out. We don't know what that level is going to be, and this might take 3 to 5 years to play out. It could take longer. So I think, is it wise to be overweight and wait a year or two? I don't know. Personally, I don't like that strategy. I have no problem if a company is fundamentally sound and you're looking 3, 5, 10 years into the future, thinking, okay, like a Target, for example, they are financially sound. I have no problem with that. But I think 1 to 2 years is too short of a time frame to be thinking about that. Calise has asked us about 3M. Look, we had a whole show on that. I don't think we need to talk about that. We have a question from Manny Mystery, and this question is about when you decided to start investing a significant part of your income and wealth. Did it take you some time to convince your partner that it was the right strategy for you?
It took me no time because my wife literally doesn't care about money. So she only complains when she goes to the shop and she wants to buy shoes and the card gets rejected.
Yeah.
So she trusts me fully with the money in this because our marriage is based on love. We don't not on these kinds of things. Of course, that might sound naive, yeah. Because who knows whatever happens, but at least she gets half of everything. So we're good here. She doesn't care. She's really more focused on quality of life. And I explained to her, she understands what it is about. She likes it. and that's it. Yeah. Yeah.
Yeah, I have a similar situation. My wife, she trusts me completely. I didn't have to convince her whatsoever. Yeah, it's quite straightforward.
Yeah, and then if you have a other half that is also already a little bit frugal by lifestyle, or and I don't mean not buying secondhand clothes, but just generally like doesn't need to live a wealthy life, is not attracted by golden necklaces and Ferraris. So let's say different. My wife is not materialistic. Yeah, which really helps here. So if you have a wife or a husband that is materialistic, I can imagine this is much harder. But in my case, it was really easy. So many, maybe reconsider your partner. No, just kidding. I think there are still some people, some women in the dividend growth investing community that might be available. We can actually do, so maybe let's say different. If there is someone available in the dividend growth investing community that's looking for a person with similar interests, let us know. We can connect you to many mystery, and yeah.
Brilliant. I love it. And then look, there was one other question from Flo who's asking us about certain REITs again. I actually think we need to do a show on real estate investment trusts, because honestly, we get some of these questions, and I feel like I need more time to understand the company and not just go over the top line figure. So I think that's one for us, European DGI.
Yeah.
I think we need to do a show on different types of REITs.
Good. Hey, thank you. We're at the end of the show. It was a really good one for me. I think I saved myself some troubles with the topic of this show. I know what to do now going forward. And although taking a loss is never nice at this part of the investment journey. So, and it's not the first one, and it will definitely not be the last one. So,
Yeah,
thanks for that one. Let us know also what you're doing about 3M if you're listening. You know where to find us on Facebook or Twitter, and see you next week again.
See you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.